Good afternoon and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with William Strauss, Senior Economic at the Federal Reserve Bank, who will be presenting on what the holiday season holds for retail. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on the side panel. We will gather all those questions and save them for a Q&A at the end of the presentation. We will also be sending a copy through email after the presentation is complete. The last item is that we will have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but it gives us a lot of great information on how we can continue to make our webinars better for you. Now, Ken Frisco will give you a brief intro of our speaker.
Thanks, Sharon. Just a quick background on Bill Strauss. He's the Senior Economist and Economic Advisor in the Economic Research Department at the Federal Reserve Bank of Chicago. His chief responsibilities include analyzing current performance of both the Midwest economy and the manufacturing sector for use in monetary policy. He organizes the bank's Economic Outlook Symposium and Automotive Outlook Symposium. In addition, he conducts industrial and manufacturing roundtables throughout the year. He earned his BA in Economics and Geography from State University in New York at Buffalo and an MA in Economics from Northwestern University. He's also a certified business economist. He is taught as an adjunct facility member at Loyola University in Chicago and Webster University in Chicago. He currently teaches at DePaul University, Kellstadt Graduate School of Business, and at the University of Chicago Graham School of Continuing Liberal and Professional Studies. His research papers include analysis of the manufacturing center, the automotive sector, and the Midwest regional economy, the trade-weighted dollar, business cycles, and the Federal Reserve payment operations. Bill is going to talk in general about the economy and how everything stands, so I'll turn it over to Bill at this point in time.
Okay, well, thank you very much, and apologies for the late start. I'm working remotely, and in fact, I'm at a banquet facility about to talk to another credit group after this webinar, and I'm in a bridal suite, so I've never done a webinar from a bridal suite, so it's pretty interesting. But happy to join you this afternoon to talk about how the upcoming holiday season is looking. Of course, I think large part that based upon how consumers are doing. So let me give you the heads up on this, so those of you who might have to drop off a little earlier. The main conclusion I'm going to draw to, and I'll lead you through the story that highlights this, is that the economy is looking all in all quite good. We're seeing job growth that is continuing. We're in the 9th year of expansion. Growth has been very moderate, but that has led to longevity, where we are in the 9th year of the expansion, with all in all little bubbles appearing in the economy. Certainly when you look at the real side, slack seems to be existing throughout the economy, and that means that we probably don't need to see a sector correct itself in order to bring things back into balance. So there's room to grow, although the growth rates we're going to be looking at and thinking about are really going to be decent growth, but not impressive growth. So let's start off by looking at our number one measurement of how the economy is doing in the United States, and that is, what is the growth of real GDP, the final value of all goods and services produced in a given period. And we do not have data for the third quarter yet, even though we are now well into the fourth quarter. But it's part of the problem with the GDP numbers is that they're quarterly and they have quite a bit of a lag, so we won't even get our first look at that for another couple of weeks. That being said, we do have data through the second quarter, and year over year, for the second quarter of this year, second quarter last year, growth is coming at 2.2%. This is all in all quite decent. The view is that we should be able to grow the U.S. economy based upon labor force growth, based upon productivity growth, at something around 1.8 to 2%. So we've done a little bit better over the past year with regard to that, but barely better than that trend. In addition, Some people have caught the fact that second quarter GDP came in at more than 3%, just over 3%, and are getting excited. Is this the harbinger of more to come? Well, as you can see in the chart, GDP on a quarterly basis, the red bars, does bounce around quite a bit. And while it's nice to talk about the second quarter, I think it's doing a disservice to the data not to look at the first quarter, which was actually just barely over 1%. So for the first half of this year, we're still talking about an economy that is barely growing over 2%. Now, while we don't have GDP for the third quarter yet, we have another indicator, I think, that we can look at to give us a sense of how the third quarter is performing. And that's what's called the Chicago Fed National Activity Index. That black line going across the screen, what that signifies is that when our indicator is at that, it says the economy is growing near its trend rate of growth. If it's above it, we're doing a bit better than trend. And if it happens to go below it, we could be looking at a worse than trend performance. If it gets down too low, that shaded area that I just added, about a minus 0.7 to a minus 1.3, that's where we have to be a bit concerned about slipping into a recession. As we can see with the most recent data, which is through August, so 2/3 out of the third quarter reflected in that number, what we're seeing there is the fact that growth is continuing. It is just barely below zero, so it suggests that we're not seeing an economy that is accelerating, that it still seems to be an economy growing around its trend rate of growth. The good news, though, is that we are far away from that risk of recession zone, that minus 0.7 to minus 1.3. The stock market, as we are well aware, are doing quite well. And this is going to be very helpful because as consumers and others look at their holdings of the 401k and other investments in equity markets, they're feeling pretty good. This will translate into some additional spending known as the wealth effect. When people look at their gains in equities, they'll spend a very small portion of it, 2, maybe 3% of those gains will translate into additional spending. So the good news is that with the strong gains that we've seen over the past year, that will be quite an assistance as we head into the holiday period. The housing market, to give one example about an industry that is still far from being normal, has continued to show some improvement. The Blue Chip Forecast Group, which is roughly 50 professional forecasters, well, they're predicting housing starts, both multifamily and single family, for next year at just under 1.3 million. This is what would be considered below what normally should be occurring based on demographics. So we should be looking at something closer to 1.4 to 1.5 million. So we're over 100,000 short of that even next year. So this is, again, an example of a market that still has quite a bit of room to grow, quite a bit of slack in it. So what is expected? So the FOMC, the Monetary Policy Deliberating Committee for the Fed, which is known as the Federal Market Committee, 4 times a year, they offer up what is known as a Summary of Economic Projections, the SEP, and the most recent one occurred just a few short weeks ago in September. And what the Fed is sharing is that they believe growth this year will come in around 2.4%, a bit stronger than what it has averaged for the first half of the year, as well as over the past year, based on the second quarter over second quarter, by a little bit. In fact, this is also a bit higher than what the Fed was thinking back in June. This is even in light of, or I should really point out, because of the hurricanes that worked their way through the U.S. with Harvey and Irma and Marie. These hurricanes disrupted a lot of activity, did a lot of damage, and so the repairs and replacement of goods and buildings and so forth are going to really foster a lot of additional spending, in particular in the fourth quarter. So in fact, the Fed increased it by a little bit. But as you can see, it's temporary because the outlook going forward is for growth to come in right around the trend, that's the blue shaded area there, of 1.8 to 2%. So, and that's roughly what we have averaged since the middle of 2009, which has just been 2.1% growth. So it's been kind of a, as I phrase it, a tortoise-like expansion, kind of moderate and steady growth, decent growth again, but not impressive growth. So when we look at how we have been doing compared to, say, what a typical expansion would look like, we have here what's known as a cycle chart. I've indexed the trough quarters of GDP for the early 80s and the mid-70s, two of the previous steep downturns, as well as the current cycle in blue. And I went out 32 quarters, takes us up to 8 years, the second quarter of this year. And what you can see is that the growth in the earlier cycles was far more impressive. The way you could read those is that the early 80s, the brown line, ended after roughly 7 3/4 years of expansion before it went into a recession, but it accomplished an amazing growth of over 35%, whereas the current cycle, which is now at 8 years, is not even at 20%. We can put annualized growth rates on those two cycles, and the growth rate was impressive, well over 4% growth. That is a spectacular expansion, well above what we regard as trend, and that is how you bring down all the slack in the economy very quickly, all the unused resources, people who are unemployed, machines that are sitting idle. And it's such a robust period, you hire even more people and purchase even more equipment to grow the economy. Where we are with this cycle, even though it's now the third longest expansion, as I mentioned, growing at just 2.1%, barely over trends, and that's why even in the ninth year of an expansion, as you look around, we're seeing slack that abounds. In terms of the concerns about could we be looking at a recession since it's been going on so long, well, you have to think about what are the economic shocks that could drive us down. And the survey of professional forecasters who are asked what do they think the probability of a recession is in the next 2 quarters, basically they had lowered their expectations from last year. You can see it had been building up from 2015, reaching a peak towards the end of last year, and it has pulled back somewhat. So there is less concern about a recession today than there was last year. With regard to the growth of the labor market, we've been adding a lot of jobs. 1.8 million is much faster than trend based upon labor force growth, which would be closer to 0.8% per year. We're practically at 1.4% at this time. So we're adding a lot of jobs to the economy. Those are people that are getting more income, and that again will assist in the purchasing power for retail. So if you look again for a positive sign, the labor markets continue to show some additional gains in terms of individuals. We'll talk about how those individuals that already are working are doing, but at least we continue to add more and more people into the roles of the workers. The unemployment rate has fallen down to a very low level of 4.2%. But as I mentioned, when you look at the growth of the employment, in part, I think why we continue to hire a lot of people is that workers to the employers are a real bargain. Their costs for employing these individuals has not gone up very rapidly. You can see the green line there, wages and salaries have been kind of edging higher. Benefit costs also remaining relatively low. Both those are averaging, so the cost to employers is something barely over 2%. This is nominal. Knock out 1.5% inflation rate, for example, and you can see that for years now, employees have seen just a real income gain of less than 1%. And I think that's driving some of this. Although I believe that we're starting to see the story about the availability of all these workers coming to an end. If truly your labor force is only growing by less than 1%, you cannot continue to add workers that are more than 1% per year. The Blue Chip is forecasting, this is roughly 50 professional forecasters, that unemployment rates edge lower. The Fed sees a very similar kind of pattern, all the way out to 2020, seeing unemployment rates that remain very low and, in fact, below the roughly 4.5% to 4.8% rate that the Fed believes is what the natural rate of unemployment should be, the rate that we gravitate towards in the long run. But I think the biggest challenge that explains why we have seen wages not rising very rapidly is because productivity has really suffered over the course of this expansion. What had been a very strong gains, as you can see, over 10 years ago at excess of 3%, we think medium-term productivity gains should be around the 1 to 1.25%. And that is how we generate out that trend growth of the economy of around 2%. But more recently, the productivity gains have been half of that amount. Over the past 5 years, it has averaged just about 0.5%, half of what we think should be accomplished with regard to productivity. I think the biggest explanatory factor for that has been a real dearth of investment taking place. And I think the story goes back to the labor side. Labor has been so reasonably priced that businesses are choosing to hire more workers. They've not made the kind of capital investments that they should have or typically would have, and therefore we've seen the shortfall on investment. In fact, you can see that last year we saw investment actually go negative compared to the year before. That almost never happens during an expansion. It happens during a downturn as businesses have tremendous slack in their demand for their goods. They're not about to buy even more machines to add more capacity, so they cut back. But usually during an expansion, they don't cut back to the point of going negative, which is what happened. But when you look at the first 2 quarters of this year, those last 2 red bars, you can see a pretty good bounce that's come about. And in fact, I think we're on the verge of seeing an investment cycle that can be quite helpful with regard to productivity, and then therefore can translate into some wage gains for the employees. Inflation, as I mentioned, about 1.5%. This is below what the Fed would like to see, closer to 2%. In part, it's been because of relatively weaker energy prices, but it's also been some one-off factors that are probably going to dissipate over time, such as one of the major cellular providers offered free data to their customers. That actually reduced the inflation for the country. It was such a major change. But the thing is, once you offer free data, you can't do it again the following year. So that will all dissipate, and we'll see a bit more upward pressure as we move into next year. But energy prices, while low, have shown some better numbers than they were, say, a year ago or two, when they got down as low as $26 and change. They're now about double that, just over $50 a barrel, and we're actually seeing some additional production taking place in the U.S. But natural gas prices also remain very low, and this is all in all very helpful to the consumer. So again, when we're talking about retail sales, I think when you look at a chart like this kind of says, how does the low energy prices benefit the consumer and perhaps retailers outside of those selling energy? So this is the share that consumers spend out of their dollar for purchasing gasoline or diesel to fill up their vehicles, paying for electricity, paying for heating costs for their home. And as of August, this was less than 4 cents out of every dollar spent, which, as you can see from a historical average, which is the green line going back to 1960, this is more than a third less of their spending dollars they're devoting towards energy than over this longer history. And certainly when you look at the decades, this is among the lowest that we've seen, ever. So this is going to translate into additional monies that are available for the consumers to spend on other goods and services. Removing food and energy prices, looking at the underlying rate of inflation, again, it's been soft in part. That story about the cellular company is driving some of that. But what is expected, according to the FOMC, is that we'll see these inflation rates, as the slack continues to be worked out of the economy, move closer towards the 2% target that the Fed has and remain there through 2020. The same pattern emerges for the forecast for the underlying rate of inflation. And I think that is all indicative of the fact that energy prices and food prices are not anticipated to do anything much different than what is occurring to overall prices. So in other words, we're not looking at a further spike or drop in either food or fuel prices. So again, when it comes all down to it, I think one of the most important factors to think about for spending for the holiday period is what's happening to real disposable personal income on a per capita basis. And as you can see, it has continued to move higher. Data through the second, this is a daily, this is quarterly data I have here. Data through the second quarter has it edging higher. So again, we're looking at consumers having more money basically than ever before in real terms. But one thing that could be a little bit of a nervous sign is the fact that consumer credit as a share of their income has risen even more quickly than disposable income. So you can see that it has bounced up over 26% compared to, if you looked at the last expansion of the notes, it was hanging out closer to 24%. So we've seen a more than 2 percentage point increase in this particular measurement. But we talked about housing, and how housing isn't even back to normal yet. And I think that's important to keep in mind that if consumers aren't putting their money towards those big-ticket purchases like housing, then they could maybe put a little bit more debt on some of the non-mortgage type of instruments. So, for example, when we look at mortgage debt as a percentage of disposable income, even though housing is slowly coming back, the mortgage debt has actually been declining and more recently flat, edging lower if you wish, but definitely not increasing. So I think there's a bit of a trade-off there. And that has allowed households' equity in real estate to improve. So this, again, I kind of think about like the wealth effect, that consumers who are seeing their homes go up in value are feeling a bit more confident and, again, likely go out and spend a bit more. Hopefully they don't do what they did back in the North, which was to extract the capital gains and turn it into real capital losses if the home price is correct. I'm not saying they're going to correct, but nonetheless, I think consumers will probably be treating this hopefully with a bit more, hesitation to try to extract the kind of equity out of it that we saw in the past, and we'll treat it much more like something out of the equity markets. So they'll take maybe 2 or 3% of spending coming off of their gains in their home values. And ultimately, it comes down to what are you spending for all of your debt that you're holding? So you look at the household financial obligations ratio against the disposable income, and as you can see, if anything, that has come down, largely because of that mortgage, because we know that the consumer side, consumer debt, has edged a bit higher, moved a bit higher, but still, the mortgage is dominating this story. And in fact, the household financial obligations ratio remains very low. So that puts my mind at ease with regard to that first chart on the credit side, which had increased, that all in all, things are holding in there. On the industrial side, manufacturing, we're seeing some gains occurring there. So that's good, especially since the auto side is pulling back somewhat. But capacity utilization has been just edging a bit higher. But as mentioned, vehicle sales have pulled back this year. Short of that last data point, which was September, vehicle sales were down by over 2%. We saw a surge in September. I would imagine a big part of that surge is replacement of vehicles that were destroyed during Hurricane Harvey in particular. So this will be a temporary blip higher, but it has taken vehicle sales from being over 2% down by over only 1.4% lower. But to give you another illustration of how low energy prices affect consumers, it's affecting the choice of the products they wish to purchase. They are clearly favoring the larger, less fuel-efficient products because light truck sales, which includes pickups, sport utility vehicles, crossover vehicles, is rising by 5% in the first 9 months of this year compared to the first 9 months of last year, whereas passenger cars are up by over 11%. So this is, again, a real indication of the fact that consumers respond to energy prices by altering the type of products they purchase. And what is Blue Chip expecting? Well, they're actually expecting that vehicle sales are going to move a bit lower this year, about 16.9 million units, and then just stick a little lower below that at 16.8. These would still be very profitable levels, and if anything, when we had a record selling rate last year for vehicles, there were a few people who were concerned about whether we were pushing too much product to the consumer and whether or not we were looking at a bit of a bubble with regard to the consumer. So the very fact that things have pulled back is probably some good news for this particular market, and probably puts, again, the outlook for the economy at less risk. And in terms of manufacturing in general, all you need to do is look at the Purchasing Managers Index, which has soared up to a level that we have not seen in 13 years. And so now we've got Purchasing Managers Composite Index at over 60. 50 is a break-even. Above 50 means expansion. And the higher above 50 you are, the more it is. And you can see that things have really accelerated in the last few months, or basically the past year. So what is expected? Well, Blue Chip is anticipating that we'll be seeing manufacturing grow by about 2.7% this year. That's roughly in line with its long-run growth, and about 2.3% for next year. A bit slower, but still, all in all, not bad. So now let's just close up by talking about financial markets and Fed policy. So there's a financial market indicator that I think is another thing to look at beyond just, say, the survey of professional forecasters when thinking about a recession. I like this kind of indicator because, unlike asking somebody's opinion about what they think may or may not occur, when you go into a financial market and put dollars on the table, you're basically putting dollars behind your words. And the way I interpret this credit spread is, of course, it is basically the same product. These are corporate bonds, but with different credit behind them. First one is corporate AAA, so the best companies out there, and what their cost to borrow from the market is, compared with the cost to borrow from the worst companies out there, the high-yield companies, often referred to as junk bond issuing companies. And if you think that we're about to go into a recession, you would begin to get more nervous about the risky company because they are far more likely, therefore, to potentially go into bankruptcy and not pay you back. And therefore, as you think you're going to go into some riskier times, you're going to ask for a higher risk premium, in other words, a little more interest rate from those risky parties. You can see, if you go back to 2007, how right before the financial crisis, things were moving higher. Financial crisis hits in the middle of 2008 or towards the end of 2008, and you see it skyrocket. It worked its way down, popped up in 2011 during the period when we had the debacle about U.S. government securities getting downgraded. Increased in 2015 with some of the words around what was going on with ISIS, and then has come down since the early part of 2016, and more importantly, through 2017 has remained, all in all, quite low. Now, this is a daily indicator here, and in fact, it's updated through Tuesday. So as you can see, as of Tuesday, there appears to be no signs that this financial market appears to be the least bit concerned about a potential recession on the horizon. So in light of all of this, the fact that the economy's growth has been moderate, inflation still below our target, unemployment rates, while a bit low relative to the natural rate, has yet to really put any kind of pressure on the on the wages and benefits, which again would push inflation up a bit. But in light of all of this, the Fed has been slowly removing its very expansionary accommodation to the economy. And beginning in December 2015, the Fed began to increase interest rates. Since then, we've increased them by 4 times at 25 basis points each time, getting it just over 1% currently. What is expected? Well, at the September meeting, the Fed seemed to suggest that we might have one more rate move in the final quarter of this year. We have 2 more meetings left, one coming up in a couple of weeks. And then in addition, we would have 3 rate moves next year, and not until 2019 do we move into that blue shaded area. That's the range that the policymakers believe is the neutral stance for monetary policy. So as long as we are below, as we are going to be in 2017 and likely in 2018, we're going to be looking at Fed policy that is still pushing on economic growth, still encouraging more economic growth than trends. But as we approach that 2.5% to 3% range, the amount of accommodation is moderating. And by the time we get into 2019 and remain there in 2020, the Fed's policy should be neither stimulative nor contractionary with regard to the U.S. growth. It should just be operating on its own accord without any assistance or any kind of detraction coming from the Fed. Now, while we did not change interest rates at our last meeting, we did acknowledge that we're going to start reducing our balance sheet. Last June, the Fed indicated with some clear numbers the policy path that we would begin to do. We didn't say exactly when we would start it, but in this past meeting in September, we clarified that the policy of reducing the balance sheet to some degree will commence in October, this month. We're going to take our time. You can see that we went from $800 billion back in 2007 to more than $4 trillion today. Be aware that while it has been flat now for several years, it has not been flat because the Fed hasn't done anything. In fact, these are securities. They mature. Some get paid off early. And we are losing something on the order of roughly, let's call it $50 billion worth of securities each month, just rolling off the balance sheet. So in order to maintain the size of the balance sheet, the Fed has been purchasing whatever has fallen off of the balance sheet to keep its size up there. So what the Fed will begin to do, beginning with this month and proceeding each month for this month through the end of the year, is we will allow $10 billion to roll off the balance sheet. Doesn't sound like a lot. It certainly isn't a lot relative to the size of the balance sheet, but this is the first step to see how the financial markets deal with having to basically purchase on their own these additional amount of securities, since the Fed will not be a buyer. We will begin to increase that further in the first quarter, increasing it to $20 billion. In the second quarter, we will increase it to $30 billion. You can kind of see where I'm going. In the third quarter, we'll increase to $40 billion. And a year from now, in the fourth quarter of next year, we will bring it up to $50 billion per month. And that's all we've stated at this point, is we will go at that point up to $50 billion. We haven't said what we would be doing in 2019 quite yet. That being said, we also have not said exactly what our target is for the size of the balance sheet falling. All we have stated was it will be something above $800 billion, recognizing that over time you do want the monetary base to increase, reflecting the growing size of the U.S. economy. So it will be higher than $800 billion, but exactly how high we have yet to formally name. So that leaves us with a summary that we're looking at, all in all, a very decent outlook for the economy. Probably, I think the way you want to characterize and think about this is that the growth path is not going to be that much different than what we have witnessed for the past 8 years. However, with slack being eliminated out of the economy, we're probably going to be looking at a different investment cycle, a little softening on the labor side in terms of growth of employment, but with probably some additional wage pressure. So offsetting the lack of job creation will be some gains of income. So per capita income might actually be looking pretty good, even better than what we've seen in the past few years. And again, over this period of time, the Fed bringing our policy accommodation to a neutral stance, and that the economy, if it gets into the second half of 2019 without a recession, and I think we're looking at very good reasons to believe that's possible, we'll be looking at the longest expansion in U.S. history, which was a full 10 years, and we would achieve that in reach July 2019 without a recession. So with that, we have time for some questions. I'll be happy to try and answer those. Thank you.
Okay, William, let me start with the first question that was submitted. The question is housing start indicator less relevant considering the amount of money spent on rehab and renovation, the HGTV effect?
So so I gave you housing starts. What we also look at is residential investments, and residential investment would include the spending on, redoing a kitchen and updating this, adding an expansion, an additional room and things like that. That's doing okay. Again, not setting the world on fire from a historical standpoint. As a share of total GDP, it is well below the roughly 4% that it has typically should average. So, I think the individual is right that a lot of people who maybe are a bit stuck in their homes and maybe not wanting to move are choosing to rehab their homes. It does get reflected in residential investment, which again is doing okay, but again, it's not like all of a sudden the weakness in the housing starts is because people are choosing to stay in their homes. I think it's just a little bit of chicken and the egg with regard to some of that, but we do keep track of the home improvement stuff.
Okay, William, the second question I have, if the U.S. is to grow GDP to 3% as the president wants, what sectors could drive that? Would USD repatriation fuel growth?
Yeah, all right, so two questions there. So first, with regard to 3% growth, so there are only two ways of growing an economy. The first way is labor force growth, having more hands to do the work of the economy. In the United States, our labor force is growing at less than 1%, as I mentioned. The actual number is 0.8%. By the way, half of that is due to native births, so Americans having children. The other 0.4% comes from immigration. So one way that we could get a little bit faster growth is to have our population grow more rapidly. That's a high hurdle, especially for a developed economy. So getting people to have more children, again, pretty tough. We're seeing, in fact, many countries around the world experiencing negative population growth, Japan, Italy, and so forth. So the other thing is to, open up your borders and allow even more people to immigrate. And we certainly have a backlog of people who'd like to come here. That seems less likely with the current administration. But again, they've talked about trying to allow the right people to come in. In other words, not trying to necessarily push for family reunification, but perhaps go for the kind of talent that our knowledge-based economy requires. But nothing's been done with regard to that. And again, it hardly move the needle, given the size of our population. Again, over 300 million people. The second thing is to do things more efficiently. In other words, try to boost productivity. Productivity growth, as I mentioned, about 1 to 1.25%. So to achieve 3%, we would basically have to double the amount of productivity growth we have in our country. Again, a very, very high hurdle to get over. What could do that? Well, there are all kinds of incentives to give businesses more reasons to invest. I think we are looking at an investment cycle which will boost productivity, but I think it's going to boost it back up to what I view as its trend of 1 to 1.25%. But to get it up much higher would require a very, very different way that we think about businesses, and maybe we can get growth that could exceed 2%, but I think 3%, in my own personal view, the Fed has no view on this, but my own personal view would be very difficult. With regard to the repatriation of money that is sitting outside the U.S., in terms of having that help us, I think that is less likely. Now, we could talk about reasons why you want to have a tax system that does not penalize, earnings from outside the United States, to have kind of this territorial tax system in place, and that's for efficiency purposes. But there is a view out there, and perhaps the questioner is thinking this, that, if we allow all this money to come back, we will see this splurge on investment. Businesses are not going to invest just because they have money. Businesses are going to invest because there's a reason to invest. And in fact, interest rates, which is part of the Fed's strategy of having low interest rates, is to encourage businesses to invest. And therefore, if businesses currently have or have had reasons to invest, they've already done it. The additional monies coming in, I don't think is going to matter very much at all in terms of investment. And some people have suggested, well, let's tie it to investment. And I think that would be a horrible idea because, again, if there's no economic justification in the market for making these investments, to tie it into a program for bringing money back, that would, I think, wind up with some ill-advised investments. I think the winner on a repatriation could be the federal government, and that could be a reason for them to do it, to make it, again, more of a logical way of organizing taxing around the world. But if they did it, say, with a moderate tax rate of, say, 10% or so, that would bring in additional revenue that the federal government has not had. So there could be reasons for that we would see it.
Okay. There's another question that came in. The question is, with the Fed reducing the balance sheet, will this put pressure on Congress to reduce the deficit?
So as the Fed begins to reduce its balance sheet, and again, we're reducing it because we're trying to put it in line with the growing economy, it will mean that there's going to be one less purchaser of government securities, which means that if the government issues securities, it will potentially have where the government's going to have to offer a somewhat higher interest rate to pay for people to take their debt if there's not enough demand out there. And as the Fed has already talking about raising its short-term interest rates, so that will probably have pressure across the spectrum of the yield curve. So that would just be one other issue. But ultimately, the Fed has to do what is right for the American people based on monetary policy, and the Congress has to do what's right with regard to how they manage their debt that has been built up. We're not there to basically accommodate that. But I think the questioner is certainly raising something to think about of whether or not that will stimulate Congress to deal with some of the issues with regard to the side of the debt, which is quite high.
Okay, another question has just come in. The question is, will tax reform gain traction in the coming weeks, and do you believe any reform or lower business rates will be passed?
So that one's an easy one for me to answer, which is we don't make comments about future policy from the fiscal side. Same as we don't want the fiscal side to comment on what's appropriate monetary policy. That being said, probably like many of your listeners, when that congressional act gets passed, if it gets passed, and then signed by the president, we will take our pencils out and we will go ahead and analyze it and try to make our best judgment of what kind of an impact it will have with regard to the economy, its growth, timing, magnitude, and have that incorporated into our appropriate monetary policy stance.
Okay, William, I guess we have time for one more question. The question is, Is the pressure that Amazon is putting on competing retailers a meaningful factor for lower inflation? And do you see Fed doing a third rate increase in December if inflation remains below their 2% target?
So right now, inflation is low for the fact that, again, energy prices were a bit softer, although they've come up a bit of late. And again, in part because of this issue, this one-time issue. We do believe that as slack gets worked out of the economy, I gave one example about the labor market, housing market would be another, that there will be some additional upward pressure that will be pushing inflation up to the 2% target. Given the lags of monetary policy, the Fed has to be very forward-looking. That's why when I shared with you the Fed outlook, we've got numbers out there going out to 2020. When I meet with our president of the Chicago Fed, Charlie Evans, in a couple of weeks, to a degree, when I'm talking with him, I'm not even thinking about 2017 nor the first half of 2018. I kind of think that from a monetary policy standpoint, that's in the bag. That was decided in past meetings earlier this year. So what we're really focused on is what the second half of 2018 is looking like and into 2019. So we can't necessarily just be reacting to some short-term issue. We have to think about it from a longer-term framework. The Amazon issue is certainly a very good one to think about. It has put some downward pressure, and they continue to move into different areas to try to bring additional costs down. So we'll be monitoring that, but that is ultimately part of how the inflation gets calculated. Wasn't that long ago that everybody was talking about Walmart and the Walmart effect. So now we have the Amazon effect. I'm kind of waiting to see what the next thing in retail is that all of a sudden challenges the economy.
Okay, William. With that, we are going to close today's webinar. I would like to thank William Strauss for taking the time to present to our group today, and thank all of today's attendees for taking time out of their day to join us. Thank you all again, and we look forward to seeing you at our next webinar.